So we'll start with the most important one, which is capital allowance. I'll come to all these ones, financial instruments and all that, but I feel the most important deduction, okay, which fetches a lot of marks, and even in the exam, it comes on its own, is capital allowance, right? If we understand capital allowance, we understand tax. So the very first one I'll look at is capital allowance. Then we'll take our time and come and look at all the other deductions too. I hope that is okay. Do you have any questions for me? Any questions for me? Any question for me?
No, you can proceed.
Okay, that's fine. So in that case, what is capital allowance? The commissioner calls capital allowance depreciation allowance. So what is depreciation allowance? I call depreciation allowance or capital allowance as a standardized deductible allowance that is given or granted in place of accounting depreciation by the tax law. So you realize that when we're looking at section 133 right now, we realize that what? Depreciation was not an allowable expenditure. It was what? An excluded expenditure. Do you remember? So if the tax law is not allowing depreciation, then you should give us something that will replace the accounting depreciation. True or false? Because when assets are consumed, we need to capture it as a consumption expenditure in our statement. And so the tax law rather gives us capital allowance in place of accounting depreciation. Please, is that okay? So it is a standard allowable deduction given in place of accounting depreciation by the tax law, and it is covered under the third schedule of the Income Tax Act together with section 14. Okay, now capital allowance is granted for depreciable assets that are owned and used in the production of income of that person from business. It means that so far as the asset is not depreciable, capital allowance cannot be taken. And if it is not used in the generation of your income from your business, we cannot what? Claim it, right? It is calculated in line with the provisions specified in the third schedule, and capital allowance is granted to a person for a year of assessment for each pool of depreciable asset with respect to each basis period of that person ending in the year of assessment. And it is only granted for depreciable assets. I told you earlier on, right? Now, before you can go, this is a typical exam question that is always asked in your exams. What are the rules for granting capital allowance? It comes and it's 5 solid marks. Please don't forget it. Some things, students are only concerned about calculation. That is why most of the time they fail tax. But remember, tax is law. So it's not always about calculation, right? You must know the rules to answer the questions. You use them as underlying assumptions. So base rule for granting capital allowance. 1, capital allowance is granted for depreciable asset. I've mentioned it 3 times today. Don't forget. And 2, even if it's a depreciable asset, was it owned by the business in question? So 1, depreciable asset. 2, it must be owned by the business. 3, the depreciable asset must be used in what? Carrying on the business during the relevant basis period, and it must be used or temporarily disused as at the last day of the basis period. So it means that even though the asset may not be used at that particular time, at the end of the year, that last day that the business is closing to go to the next year, the asset might be in use or it might be temporarily out of use. That means during the year it was still used, right? Then we still allow. Now, it must be owned at the end of the basis period by the person. So even if you use it and you sell it at the end of the year, it will not meet the condition for granting capital allowance. And remember, we shall not defer capital allowance. In the past, under 592, if you had capital allowance for this year, and then let's say you had profit of 50,000, right? But you calculated capital allowance of 100,000. That means you can only deduct 50,000 capital allowance, right? So the 50 left could have been carried forward to the next year. It could have been deferred. And that's what businesses were doing. If they realize that next year will not be good, or next year will be very good, they'll shift all the capital allowances to that year so that they can claim it around that income. So as an anti-avoidance provision, this law was created to help people to not defer capital allowances just anyhow, to use it to smoothen their profits, right? So that is why capital allowance shall not be deferred. Okay, so these are the rules for the base rules for granting of capital allowances to businesses, whether individuals or to companies or corporates. Is that okay? I hope you've gotten the base rules. You can write it in your own words and then we proceed. Shall we proceed? However, there's a rule which helps us to defer capital allowances under 896, and that is where you are dealing with losses. Losses, including capital allowances, can be carried forward for 5 years. in the order in which the loss was incurred. And when we get to losses, I will make sure you understand losses very, very well. Are we okay? So this means that capital allowance granted shall be treated as any expense deductible against income by actually deducting such capital allowance amount from the assessable income in arising at the chargeable income of that person for that year of assessment. Are we okay? So what then is a depreciable asset? We said that what? Capital allowance is granted to depreciable asset, right? So a depreciable asset means an asset to the extent to which it is used in the production of income from a business and which is likely to lose value because of either wear and tear, obsolescence, which is it has gone out of fashion or out of date, right? And the passage of time. Okay, so anytime you have assets that lose value because of wear and tear, obsolescence, or the passage of time, I get it. It is a depreciable asset. And depreciable asset does not include things like one, goodwill. It does not include an interest in land. It does not include a membership interest in an entity or trading stock, right? So these three things do not constitute what? They do not constitute trading depreciable assets. Are we okay? So anytime you may go and the tax examiner will ask you, what does not constitute depreciable asset? Or give examples of things that are not depreciable assets. So goodwill is not a depreciable asset. Land is not a depreciable asset. Buying of shares are not depreciable assets. Trading stocks are not depreciable assets, right? They are more likely to be capital or investment in nature. Are we okay? Makes sense. Can we move? Can we move? We have a lot to do. Can we move? Can we move? Can we move? Shall we proceed?
Yes, sir.
Okay.
Yes, sir.
Now, we have seen depreciable assets that they do not include things like what? And I'm listening. Depreciable assets do not include things like what? One,
It's a good one.
goodwill, and then what again?
Land.
Land, land, trading stock and membership interest in an entity, no be so. Okay, so let's look at the classification of depreciable assets. Now we have 5 classes of depreciable assets in our Ghanaian tax law, right? 5 classes of depreciable assets. Now, one thing you must understand is that within this 5 classes, right? 3 of them use what we call the pool system. And I'll explain what the pool system means, right? 3 of them uses what we call the pool system, and 2 classes do not use the pool system. They're in a pool of their own, meaning that each of them, if you have 5 of them, each one will be in its own pool, right? So these 2 classes that we have, I get on their pool of their own. So the first 3 classes uses reducing balance, and the second 2 classes uses what we call straight line, okay? Straight line depreciation. Pool system means that each individual asset will lose its identity. So let's say if I have computers, right? If I have computers, let's say I have Dell, I have HP, I have Lenovo, right? And I have speakers. Okay, I have speakers, I have microphone, okay? You know, if we were doing accounting, we would have classified the computer separately, the speaker and the microphone separately with separate accounts, right? But under the pool system, all these ones will be put together and called class 1. Meaning that we cannot depreciate only microphone like we would have done in accounting. We will depreciate all of them as one asset, meaning that assets in the pool lose their individual identities. So if we sell the microphone, it will be like we are disposing of part of the pool, but not microphone, right? So once you put an asset in a pool for tax purposes, it is not called microphone again. It forms part of the full pool and it's called class 1 or pool 1. So that is the pool system. The individual assets lose their individual identities. So if you are asked in exam, what is the pool system? What are you going to say? Somebody should tell me something. What is the pool system of depreciable assets? What's the pool system? What is the pool system? Nobody said.
There's a system of classifying assets where each individual asset loses its, no, I say, loses its what?
Original.
Its identity.
Yes.
Yeah.
It means that once you account for one, you're accounting for all. Do you understand?
Oh.
Thank you. I want you to get, if you get these things, trust me, tax will not be an issue for you. These are where students have their issues. So now we know how many classes apply the pool system.
3.
Right. So class 1 to class 3 use the pool system. Okay, so let's look at what which of the pools uses reducing balance method. I mentioned that the assets that uses reducing balance method for depreciation. Which one use straight line? Which ones use reducing balance depreciation?
Class 1, 2, and 3.
Class 1, 2, and 3. And which ones uses straight line?
4 and 5.
4 and 5. Okay, thank you. Now let's look at the assets in each of the pools. Very important. Okay, sometimes students go, they don't know where these assets fall. So let's see, computers and data handling equipment together with peripheral devices, 40% reducing balance, right? But before we look at this, let me show you how to compute the depreciation or the capital allowance for each of the asset classes, right? So for pool 1 to pool 3 assets, the ones that use the pool system. So pool 1 to pool 3 assets or class 1 to class 3 asset, right? We get capital allowance or depreciation allowance as, okay, so look. So in that, we calculate capital allowance as what? Our depreciation basis, which is what we compute capital allowance on. So our depreciation basis times the capital allowance rate, okay, the capital allowance rate or the percentage times the number of days the person operated in the basis period out of 365 days. Now, let me give you this rule. Students always forget this. I don't know why. Now listen carefully. For tax, we always grant full year capital allowance unless you didn't operate the whole year. What did I say? What did I say?
Whole year capital allowance is granted unless
Failure to operate.
Yes. So it means that, let's see, if Kumi, okay, if Kumi started business, let's see, if Kumi started business on 1st July 2019, also, and bought the following assets. So he bought computers, also computers, 100,000, bought printers, okay, bought printers for 200,000, bought office equipment, okay, bought office equipment for 500,000, also bought what do we call it? Let's say air condition, right? Air condition for 500,000. Then maybe some vehicles, right? He bought some vehicles, buses for 1.5 million, right? This is what he acquired when he started business in July 2019. And one thing you should understand is that when it comes to individuals, right? In tax accounting rules, individuals, no matter where they start business, we always have to use the calendar year as their basis period of assessing them for tax, right? So it means that if this guy started 1st July 2019, you don't have to end in June 2020, no. It means that we only account up to 31st December that year. Do you get a rule? Individuals, we always use what? The calendar year. So individuals and partners, remember partners are also individuals. So partnership and individual, their basis period is always the calendar year. So it means that if you're an individual, no matter what you do, we are accounting for you up to 31st December. So remember that when you look at this capital allowance rate that we have here, it says what? The number of days in the basis period out of 365 days. So you ask yourself, how many days would this guy have operated during the year? How many days would he have operated during the year? How many days would you have operated? You need to count. So let's find written down values brought forward, right? So let's say pool one, these guys had written down value of, let's say, 60,000 brought forward from the previous year, which is 20. Oh no, he just started business, sorry. So I can't bring written down value. But let's say 2020, okay? Let me just give 2020 year of assessment. He made some acquisitions. I just want to show you the basics. So acquisitions, he bought more computers for 400,000, okay? Then he bought an office machines. He bought some office machine for 1.2 million, also. Then he bought a Toyota Camry for 100,000. Okay, there's a caveat attached to this. Then he bought okay, let's say that's what these are all the acquisition. Then he sold computer for 120,000 and one bus for 90,000. Okay, so this is what we have, and they say we should compute the capital allowance for 2019 and 2020. Just simple question. Have you written it down? Just write it down. So Kumi started business on 1st July 2019 and acquired the following assets, which you have. Then 2022, I've given you, these are the assets he acquired and the assets he sold. Can you see the question where it's scattered? Let me just clean some of these things too. So now you can put it down. I hope now the question is clear. Is the question clear now? Is the question clear now?
So you clean the requirements.
Oh no, compute capital allowance for 2019 and 2020 for Kumi. So compute capital allowance for
Yes, sir.
2019 and 2020 year of assessment. If you are done, you tell me, then we move. Let me get some water. Is are we all there now? Can we start? Can we start?
Yes.
Okay. So the first thing we need to do is to get the number of days he operated in the basis period. So 2019 year of assessment, right? So what's the number of days in the basis period? How many days did he operate? So this way you have to remember your 30 days are September, April, June, and November, right? All the rest have 31. So June, he started July, right?
Yes, July.
31 days. August,
August 31.
September, 30.
30.
October,
31.
31. November,
30.
30. And December,
31.
31. Okay. So when we add all, 1, 2, 3, 4, 5, 6. This 380 plus 1, 2, 3,
184.
184 days, right? So you see, so always you have to calculate, meaning that no matter what we calculate, we must always multiply by 184 over 365 days, right? Do you get it? And this is the calculation you have to do and put it down. Because the first year you start business, if you do not start from 1st January, okay, if it's an individual, you have to check. If it's a company, to check whether it falls in their accounting period or not. So it's only companies and trusts who can use their own accounting period to do capital allowance. But for individuals, it's always the calendar year. Is that okay? So what's the basis period? The basis period, always when you're doing tax, you need to reflect it. So from 1st July, right, 2019 to 31st what? December 2019, right? We've got it. So what were the pools? So we have pool 1, which is 40% depreciation. We have pool 2, which is 30% depreciation. And we have pool 3, which is 20% depreciation, right? Then always we have the total column, which is for the total capital allowance. I hope you are all following. I hope you are all following. So since this is the first year, we bring the cost. And the cost, you always need to go and work for it. So let's go and then create a simple working for the cost of the assets. So I call that the cost classification. Okay, so what assets did we buy and what costs do they belong to? So we can bring up pool 1, pool 2, and pool 3, because I'm talking about the pool system, right? What assets fall into that arena? Pool 1 is for computer and equipment, computer and peripheral. Pool 2 is for vehicles, manufacturing plants, and then long-term cropping plants. And pool 3 is for any other asset that is not that pool except building and physical structures. Okay, so what and what did we have? Computers. How much?
100.
Pool 1, right? Then what else did
Yes, pool 1.
What else did they buy that year? Those who were,
Printers.
Printers.
where will printers go?
Pool 1.
How much?
200,000.
Usually GRA treats printers as office equipment. I don't know why. Do you agree with them? They treat printers in pool 3.
Eh.
But printer is actually a peripheral, so I don't know why. Who can tell me why they think why they have a point? Why do they have a point? To treat printers in three. Faustina, do you want to say something? Well, let's leave it for another day. Okay, so we have computers, we have printers. What else? Please, we have a lot to do. We have long questions to solve. Please, let's speed up. That's why I made you write the question.
That's all for pool 1.
No, just mention the asset as they are. We'll be placing it in the pools.
Okay.
Ah,
Office
okay.
equipment,
Office
500,000.
pool 3.
Office, what follows?
Air conditioners, 500.
Air condition. 500,000, right?
Yes.
Then what follows?
Office equipment,
Office,
500,000.
pool 3 again, right? Then what?
Then vehicles, buses, 1.5 million.
Pool 2, right? 1.5 million. So, was there any other assets, or these were all we acquired during that year?
That's all. For the year, for 29.
This will give us 300,000 also. This will
Sure, no.
This will give us 1 million. Okay, so we cost. This one was how much? 300,000 also. This was 1.5 million. And this was what? 1 million. This was the first time we can compute our capital allowance, not so. So capital allowance for that year. How many days? We operated 184 days out of 365. So it means that any capital allowance that you are going to compute, you make sure that you take what? You multiply it by 184 out of 365. Is that okay? So let's go. The first one is what? 300,000 at what? At 40%. Remember the formula. The formula was what? Capital allowance give us a percentage times the depreciation basis, right? What we are computing the depreciation times number of days.
Oh, yeah, it's different.
Some people's background, they should kindly mute. So 300,000 at 40%, not so. By 184 over 365. This is the first year, so you wouldn't have operated for the whole year. And that gives us what? That gives us 6493.15. I don't need any decimals now, right? And that one was 1.5 million going for 30% by 184 divided by 365, right? Are we okay? And that one gives us 226,849. And then we have 1 million going by 20% by 184 days out of 365. And that gives us 10822, right? So you sum all the capital allowances, 6493 plus 226849 plus 10822. I mean, the total capital allowance, which you can go and deduct from your expenses, is 388,164, right? But once I deduct this, I now come and get the carrying amount, which is a written down value carried forward to the next year, right? This is a written down value carried forward to the next year. So we have 300,000 minus 60,493. And that gives us 239,507. And we have 1.5 million minus 226,849. And that gives us 127,3151. It's 127,3151. Then we have 1 million minus 100 822. That gives us 899178. Are we okay? You see how easy this is. So always, this is what I'm concerned about. You counting the number of days the person has operated. So this was 2019 year of assessment, right? We said that earlier on, 2019 year of assessment with basis period from what, 1st of the 1st, 2019, 1st of the 7th, 2019 to 31st of the 12th, 2019, right? And that was what, 184 days. Okay. Now we come to the 2020 year of assessment, right? And 2020 year of assessment was the basis period. 2020 would have operated for the whole year, right? So 1st of the 1st, 2020, 1st January to 31st December, 2020. Do you all agree? Do you all agree that if you started business in July, that means this year you would have been operating for the whole year? True or false? Unless you exist your business, right? Do you all agree? Do you all agree?
Yes,
Yes,
Yes.
yes, sir.
That means how many days did they operate? 365 out
365.
of 365, right? Always do this to remind yourself how many days. So we have 239,507 plus 1,273, 151, and this one becomes 899,178, right? So were there any additions? Did they buy any new assets during that year?
Yes, they did.
What assets did they buy?
Computers, 400,000.
So it goes to this pool, right? And what else?
Office equipment,
Pool 3, right? How much?
1.2.
1.2 million. And then what else did they buy?
A vehicle, Tacoma. Sorry, Camry. Camry. 100,000.
100,000. But there's a rule with non-commercial vehicles, right? So when we talk about non-commercial vehicle, a non-commercial vehicle is a vehicle which is not used. So first, let's look at what a commercial vehicle is. Now, a commercial vehicle is a vehicle that can be used for three things. One, can be used in commercial activity, right? So normal taxi or rental business. And two, the vehicle has the capacity of what? Carrying more than half a ton or carrying up to what? 13 passengers. Now my question is, can Toyota Camry carry up to 13 passengers? Can it carry more than half a ton?
No.
But it can be used in commercial commercial activities, right? It may be, but mostly these are the terms you are looking for. Can it carry more than half a ton or more than 10? It can. So any vehicle that does not meet this criteria is a non-commercial vehicle, right? And the law says limit its capital expenditure value, right? Limit its value to 75,000 cedis for capital allowance purposes all the time. Remember?
Yes,
Yes, boss.
please. So must the vehicle meet all the conditions? For instance, if Camry is printed taxi, and won't it be qualified as a commercial vehicle?
Yes, it may be used in commercial activity, but we are concerned about it being able to carry more than half a ton or 13 passengers. So the criteria must be met. All the criteria must be met, not just one. So yes, you can use it in taxi business, but however, can it carry more than half a ton or more than 13 passengers? It can't. So it becomes non-commercial in nature. So you have to limit it to 75,000. In at 592, it was 25,000. By then, inflation was not like this. But now, I think subsequently, because of inflation, this will change to 100 and something subsequently. Please, are we okay now? Habib, are you okay?
Yes, Bill, please. Thank you.
You're welcome. So in that case, we are saying that the Toyota Camry, how much will we limit it to now? Is it a commercial or non-commercial vehicle?
Non-commercial.
Non-commercial. So what's the limit?
75,000.
75. But if we buy bus, can we limit it to 75? Or we can
No.
the whole amount?
The full amount.
The whole amount, because bus carries more than half a ton and it can carry more than 13 passengers. Okay. So these were the additions. Were there any disposals? So with capital allowances, when it comes to pool 1 to pool 3 assets, when they are disposals, We are just going to take the consideration, right? How much the person paid for the asset from the pool, that is all. So did we dispose of any asset from the business? Did we dispose of any?
Yes. Yes.
What and what did we dispose of?
Computers for 120,000.
So we just take the consideration from the pool, right? Because they are pool system, if it was accounting, we will identify the particular computer, I get its account, then we go and treat disposal there. But for tax, we just take the whole consideration from the pool, right? What else did we dispose of? Some buses, for how much? Dispose of some buses for how much? Oh, those who wrote the question, that's why I gave you the question. We dispose of some buses for how much? Yes, well, this is the only disposal we had in the question.
For 90,000.
The buses.
The bus is 90,000. 90,000.
Were this the only disposals?
No, please. The bus. We dispose buses for 90,000. Yes, yes.
Okay. So at the end of the day, that's a depreciation basis, right? So a depreciation basis, and that gives us what we subtract. What do we get? Our depreciation. What do we get when we subtract? 239,507 plus 400,000 minus 120.
19,507.
Yeah, this one gives us 519,000. Now 1,273,151 plus 75,000 non-commercial vehicle plus 90,000. That's 1,258,151, right? 1,258,151. Then I have 899,178 plus 1.2 million. And that gives us 2,099,178. Are we okay? So this one now we can get our capital allowance, but we have to multiply by 365 over 365, right? Because we operated for the whole year. So we take 519,507 by what? 40%. And that gives us what? 207,802 or 803. Yeah. We have 1,258,151, 1,258,151 going for 30%. That gives us 377,445, right? And the last one, 2,099,178 going for 20%. That gives us 419,836, right? So that gives us our total capital allowance, 207,803 plus 377,445 plus 419,836. That is 1005084, which is our capital allowance for the year, right? Which is an allowable expenditure. I hope this was not a difficult calculation. This is just the basics of capital allowance. And every question you get in exam always starts with this before they add a little complications to it. Is everybody okay? I want you to really get capital allowance because it may feature as part of your exam, this diet, a full question. Okay. Faustina, your answer.
Sir, please, to get the number of days, is it when the assets, we acquire the assets,
No.
or
For
when the business?
it's a full year. It doesn't matter when you acquire the asset, but when you operated. That's why you're looking at the number of days you operated, not when the asset came in. Because every asset comes in a different time of the year, right? We do not consider when the asset came in, we consider when you operated. So even if you buy an asset on 31st December, you get full year capital allowance. So far as you operated the whole year. Faustina, are you okay now?
Yes, sir, thank you.
So every year, full capital allowance, unless you yourself, you didn't operate the whole year. Please, is everybody okay? Is everyone okay?
Yes, sir.
Are we sure we are okay? Any question?
Yes, sir.
Let's go. Yes, boss. Yes, boss. So we can see Atabedu Limited commenced business on the 1st of the 1st, 2016 and acquired the following assets for use, right? So tell me which pool will put these assets. Computers. Computers.
Class
One.
1.
One.
Class 1.
All devices.
1.
That's
1.
One. Motor vehicle, Salunka, Toyota Salunka.
3.
Cow.
2.
Two. Those are pools.
2. Yes.
Oil palm plantation.
3.
Two. Long-term plants, right?
2.
Plants IE2. So when we talk about pool 2, this is how I look at it. Pool 2, we have vehicles, right? Cars. We have long-term cropping plants, okay? Plantation costs like the oil palm plantation. And then we have manufacturing plants, okay? Manufacturing plant or equipment. So anytime you see manufacturing equipment, pool 2, you see long-term plant like cocoa plantation, coconut plantation. Those plantations, long-term plants, right? Agricultural assets, pool 2, vehicles. Are we okay? Public plant and machinery. Public plant and machinery.
3.
3. Why not 2? Because,
It's not for manufacturing.
thank you. Furniture and fittings, 3, right?
3.
Digital computers for the account office. 1.
1.
Standby,
1.
2. Vessels,
2.
3. General purpose truck.
3.
General purpose truck.
3.
2.
I don't know whether it's 2 or 3. I don't know. We have to go and check.
2.
Let's go and check. So that you see how it can be in exam. So I want you to really get it well. So let's see. Pool 1, we have computers and data handling equipment together with peripheral devices. So look at pool 2. Automobiles, buses, minibuses, goods vehicles, construction and earth moving equipment, heavy general purpose or specialized trucks. So the general purpose truck is pool 2, right? All vehicles fall in pool 2. Trucks and trailer mounted containers, plant and machinery used in what? Manufacturing. Can you see? Can you see?
Yes.
Okay. Assets resulting from expenses in respect of planting vegetation from which timber, rubber, oil palm, or other crops, which we call long-term cropping plants, costs are derived. Where the business is a timber concern or a large-scale rubber, oil palm, and other long-term plantation costs, right? They shall be treated as if the expense was incurred in securing the acquisition of a depreciable asset that is used by the person in the production of income. So people usually do not read this side, but I'm teaching you. You go, they'll tell you the person operates what? An agriculture business, and these are the costs they incurred. Some students get scared. They don't know where to put the timber cost, plantation, rubber plantation cost, and the rest. Which pool do we put them? Which pool do we put them?
2.
2.
So when you have railroad cars or trains, locomotives and equipment, vessels, barges, tugs, and similar water transportation equipment. So when we see all vehicles on land, are you getting it? They are what? Pool 2, but on the sea, on rail, in the air, like aircraft, ships, they are all in pool 3. Specialized public utility plant, equipment and machinery, office furniture, fixtures and equipment, any depreciable asset not included in any other class, then it can fall in pool 3, right? So pool 4 has to do with building structures and similar works of permanent nature. Then pool 5 is intangible assets, right? Okay. But now we are working on the pool system. And then we talked about the pool system, right? The depreciable assets of the same class are put together for capital allowance, and in the pool system, the identity of individual assets is lost. Do you remember? The assets are placed in their respective pools. 1 to 3 follow the pool system. 4 and 5 are placed in the pool of their own, separately from all other assets. Only that part of the asset which is used in the production of the income shall be placed in the pool. So some questions will tell you that, oh, this guy uses 20% of his business for what? His premises, the private premises. That means 20% of the assets are not going to be placed in the pool, only 80%, right? So open your eyes for that kind of question. So we have looked at all this. And then we know how to compute our depreciation basis, right? So depreciation basis, you always take your costs or written down value brought forward. We add our additions or disposals, and also then we come and get our depreciation basis. So our written down value plus additions minus disposal should give us our depreciation basis. Then we can calculate capital allowance on it and get our written down value carried forward. So this was the question, and this question is very easy. We are supposed to calculate depreciation for how many years? How many years do you think this will go for? Check and see. How many years? This is some questions to not tell you, but you look at the dates, right? It's the dates that you used to see. See the
Yes,
dates?
3 years.
3 years.
That means it's going to be 3 years. Should we compute or we can leave the question? It's very easy, eh? Should we solve and tackle the
Yes.
we should, eh? Okay, no problem. You all say we should solve, or we should skip and go to the difficult ones.
We should solve it.
Okay, so Atabedu Limited, that's the name of the question. When did he start? Atabedu Limited. So
1st January 2016.
computation of depreciation allowance. Depreciation allowance for the following year of assessment, right? So we have 2016 year of assessment. So we have pool 1, pool 2, pool 3, and then total capital allowance, right? Okay. What's the basis period? From 1st of the 1st, 21, 16 to 31st of the 12th, right? He started the same day. So how many days? 365 over 365, right? True or false? Always remember the days. So always count the number of days, right? Don't ever forget to. Because if you forget, your whole question might be wrong because it might affect the written down values and even the computations. Are we all okay? So in that case, what's the written down value brought forward? We didn't have any. Oh, we didn't have any written down values because that was the first year. But there were additions, right? We added some assets. No be so. So those additions, we can go and work for it. Do you remember we learned to create something we call cost classification or classification of cost? Do you remember? Do you remember?
Yes.
So let's go and classify our assets. So classification of assets. How many pools did we have there? We have pool 1, pool 2, and pool 3. Okay, so let's see. We bought computers. Computers, which pool will it go? 2016. We are first doing 2016. Computers,
Pool 1.
50,000. Okay. Then we have peripherals. Also 2016. 120,000. Okay. Then what else did we have? Motor vehicle, Toyota. 65,000, right? Pool 2. Do you all agree?
Yes.
Oil palm plantation. Where will it go to?
Sure.
Pool 2. How much? 55,000. Okay. Then we had what? Public plant and machinery. Where will it go? Was it in 2016? Yes. Public plant. Where will it go? Pool 3, right?
3. Yes.
F&F. Where will it go? Furniture and fittings. 3.
3.
80,000. Okay, so that ended 2016. So 2016, what are our additions? This one gives us 170,000, right? This one gives us what? 120,000. This one gives us 230,000. Is it correct? So these are total additions. 170, 120, 230. 170, 120, 230.
Yes.
So 170,000, 120,000, and what? 230,000. Please, the total column is for capital allowance, right? Only for capital allowance. Were there any disposals during that year? No, right? So no disposals. So disposals. We didn't have any disposals, right? So no disposals. So at the end of the day, what's our depreciation basis? We still have 170,000. We have 120,000 and 230,000, right? So in that case, capital allowance, we give him what? 365 over 365. No be so. So what do we get there?
Yes. 68,000.
For the first one? 40%.
Yes.
Next one? 120,000 going for 30%. 36,000, right?
36.
And 230,000 going by 20%, 46.
46.
So the total allowance is how much? 68 plus 36 plus 46. 150,000, no be so.
150.
So in that case, what are written down value carried forward?
The first one,
102.
170,000 minus 68,000.
102,000.
102.
And the next one?
84,000.
84.
84,000. And the last one?
184.
184.
184.
Yes.
Okay. So that was the end of 2016. So 2017 year of assessment, did we also operate the whole year? So what's our basis period? Yes, 1st January. We did, so far as we didn't close the business, right? We operated the whole year. So 31st of 2017, right? So in that case, let's see. What's our written down value brought forward for 2017? This was 102.
102, 84, and 184.
184. Okay, so were there any additions during that year?
Yes.
Okay, what and what did we have?
Computers.
We have computers.
Additional computers for the office, how much? 30K.
30,000.
On Nissan bus. Is it commercial or non-commercial? Commercial.
Yes.
So we allow all the
It's
180
commercial.
vessels,
Yes.
500,000. General purpose truck. That one came, vessels came in 2018. So it's a mistake, right?
At 28 years, the two of them, yes.
Nissan bus came in 2017. Okay, so it's only these two. Nissan bus have not
That is also, no, Nizam Bus was
180.
2017.
2017, yes.
So the 500 must go.
That should come, yeah. So these were the only additions, right? Only the two. The additional
Yes.
computers and then the Nissan bus. Okay. So what's our depreciation basis since there was no disposal? 132,000.
132.
264. Oh,
264, yes.
and still 184. No, so.
184.
To capital allowance 365 over 365. No, so. So let's get it. 2017 year of assessment.
52, 800.
800. Then this one, 264,000 going for 30%.
79, 200.
200 and 184,000 going for 20%. 36,800.
36, 800.
Allowance for that year will be what? 52,800 plus 79,200 plus 36,800. 168 800. No, so that is it.
168,800. Yes.
Our P&L. So written down value carried forward to the next year for 2017 of assessment. 132,000.
79,200.
79,200. Yes.
79,200.
264,000 minus 79,200. That's 184,800.
184,800.
147,200.
147,200.
2018 year of assessment also. And our basis period is still 1st of the 1st, 2018 to 31st of the 12th, 2018. How many days in the basis period? 365, right? So we are there the whole
Yes.
written down value brought forward. So this guy, we have 79,200 plus 184,800 for this guy, 147,200 for this guy. No, so were there any additions during the year 2018? Yes.
Yes.
For general purpose truck, 250,000 pool 2, not so. Then we bought vessels for 500,000, not so. So we get our depreciation
Yes.
increases, and that gives us what? This will still be 79.2. This will be how much? 434,800. Is it correct? And 647,200. Are my calculations correct?
Yes.
Yes.
Are you sure? It's not correct. Okay, so let's get our capital allowance for that year.
31,680.
31,680. Then this one.
Yes. 134,40.
129,440.
129,440.
So that's 291,560. So
it's 341,560.
341,560. Oh, really?
Hey, no.
1,560. These are we okay with capital allowance?
291,560. 29.
Are we all okay with pool 1 to pool 3 computation?
Yes.
Okay. Now let's go to how we compute for class 4 and class 5 assets. Now these assets, we use the straight line basis. Now for class 1 assets, class 4 assets, this is how we compute their capital allowance. Okay, so for class 4, capital allowance is giving us, are you getting it? 10% times the cost of the asset times the number of days in the basis period all over 365 days. Do you get it? So that number of days, it affects every computation. If you come to class 5, which is what? Intangibles, right? We get a capital allowance as what? The cost, are you getting it? Over the useful life, because intangibles do not have residual value. So cost over useful life times the number of days in the basis period, all over what? 365 days. These are we okay? So that one, you just take the cost and divide by the useful life. Are we okay? Good to do. Please write the formulas down. They are very important. Can we proceed? Can we proceed?
Yes.
Have you written them down? Okay. So let's see. 10-Star Transport and Haulage Limited commenced business on 1st January 2017 and prepares accounts to 31st December each year. He spends 600,000 office building on 1st April 2017. And on 1st February 2018, an extension was undertaken on the building at a cost of 100,000. So, you know, each addition or extension you make to any pool for asset, you can create a separate pool for it. For instance, this is what I would do, right? So it was what? What's the name of the business? 10-Star Transport, one of my old clients. 10-Star Transport and Haulage, TTH, right? When is the year? 2017, right? So we know that we are doing the 2017 year of what? Assessment, basis period, 1st of the 1st, 1st April. He commenced business on 1st April 2017, right? So I told you anytime you see that the date does not agree with the calendar year, what do? We calculate the number of days in the basis period, right? So 1st April means
No, it's 1st January.
He commenced business. He commenced
1st January.
1st January. Okay.
Yes, sir.
So that means it's 365 over 365. Your prices.
Sure.
20 plus 1. Yeah, okay. Okay, so it's 1st January. I thought 1st April. I saw, okay, April 2017. Sorry. Okay, so this one is 365 over 365, right? 365 over 365. Okay, so basis period, 1st of the 1st, 17 to 16 rand. Is it 16 or 17? 1st January, okay, to 31st December 2017. So it was what? Office building, right? So this one, the name of the asset is what you use. So we say office building, right? Office building.
Yes.
So 10% on cost. It's on a pool on its own, right? So office building. So written down value brought forward, there was nothing, right? But how much did we buy? They said we bought it for how much? We paid 600,000 for the building. True or false?
It's true.
What's our depreciation basis? It's still 600,000. But with this one, the capital allowance is the cost, right? The addition was the cost of the building. The capital allowance is computed on the cost of the building, right? So capital allowance is what? 10% on the 600,000. Not be so, which is 60,000. Not on this. Because if there were additions, it will still be the cost we carry forward because it's 10% on cost. Remember this, right? So 10% on cost. And I'll teach you a trick regarding these kind of assets, right? To show you how to get it even if we are in a subsequent year. So in that case, that means our written down value carried forward will be what for that year? That'll be 540,000 also. Do you all agree?
Yes.
Now in the 28th
Yes.
year of assessment, something happened. Written down value brought forward will be what? The same 540,000 also.
Yes.
Something happened. They made an extension on the asset. And I told you that anytime you improve the asset, what do?
You create a different pool.
If only you are the type whose calculation will not be messed up. So alternatively, a student can say extension for office building, right? Do you get it? Extension for office building. Then you create a separate pool for it and call it 10% on what? On cost. Do you get it? So this extension for office building, how much extension was done? 100,000 also. So I can create it separately also. And then I'll just what? Is the cost that we bring. Then we say, well, capital allowance will be what? 10%. No be so? Do you all agree? So since that
Yes.
this will be 600,000, right? It's on cost. Do you remember? This will still be 60,000 because it's on the cost. Please don't be fooled though. People compute on this. It's on the cost. Then this one will be 10,000 also on the cost. Understood? So I can bring my total capital allowance here. And then this one will be a total of 70,000 total capital allowance for the period. Makes sense? Now you get your written down value carried forward. Are we okay? Are we okay? So how much do we get then? Is it understood?
It's not 480,000.
Yes.
How much do we get in? So 540,000 minus 60,000.
480.
480.
One gives us 480,000, and then this one gives us 90,000 also. Okay. Now look at
Yes.
something here that you must understand. Alternatively, this is what I would have done, right? I would have just said office what? Office building, and then this is what I would do. I would bring my written down value brought forward for that year. Okay, I'm doing that year. And the written down value brought forward was what? I think it was 540,000. Do you remember? Then
Yes.
when I get to additions, okay, I will add that 100,000 to this, making it 600 and what? 40,000, right? But when I come to capital allowance, I'll open bracket and say what? It will be 10% times my what? My original 600,000 also plus the 10,000. Do you get it? So that I wouldn't end up computing on this one, but on the cost of the two. Do you get it? So that here becomes 70,000 straight. That when I deduct, it's still the 570,000, which is the sum of the 480 and the 90. Which one do you prefer?
The first one.
You
The
prefer
second
the
one.
first one, eh? So that you don't get confused. It's up to you.
Yes.
It's so good. Now let's go to where the business started some years ago, right? Let's see. We know that depreciation is actually computed as what? Cost minus residual value, right? Do you all remember this?
Yes.
All over what? The remaining life.
Yes.
Remaining
Right. Yes.
useful life, okay? This is the actual formula for depreciation. But in tax, we assume all assets have no residual value. So it's costs over the remaining life, right? Okay. Remaining useful life. Now let's look at something. Now, if you want to get depreciation, okay, where business started long ago or some years back, okay, and they give you the asset, you can just take the carrying amount, right? The carrying amount, or simply the written down value of the pool 4 assets, okay? You can take the written down value of the pool 4. You can take the written down value of the pool 4 asset and just divide it over the remaining useful life. This one is very important for questions where the asset, like they've started business ago. Do you understand?
Your mic is muted.
Hey, This thing, why does it mute it? Yeah, assembly. So you didn't hear the example I was giving?
No, you were muted.
And nobody said it. I'm saying that, let's say that you are in 2020, right? And they told you that the asset had written down value of 30,000. Okay, and they started business in let's say 2017. 2 years have passed already, right? So how many years does the asset has? I was asking, but everywhere was quiet. So I'm saying that, look, let's just say that A started business in 2017, right? Okay, there's a 2017. And then the written down value of the assets are given below. So written down value of the assets are given below. As at 2019 January, okay, 2019 January. So we have office building. So we have office building, which was bought. They were all assets were acquired in 2017. So office building, which was acquired in 2017, was worth 500,000, right? Then we acquired intangible, or let's say a brand name. We acquired a brand name worth 600,000, which also has, let's say, 15 years. Okay. They were all acquired in 2017. So the question is, how do we get a capital allowance for these assets? How do we get it for this? Now, we know that for pool 4, capital allowance is given as what? 10% on cost. And anytime you want to see the useful life of assets that have a straight line, just take 100 and divide by that 10. It means that these assets have a 10 years span. Do you understand? So it means that pool 4 assets are divided over 10 years. So if they are divided over 10 years, and then you acquired it 2017, and you are now in 2019, how many years have been gone?
2 years.
2 years are gone. So how many years remaining? If 2 years are gone, how many years remaining? 8 years are remaining. So that's what we use to compute the capital allowance. This is something that usually people ignore in class, but it's killing students all the time. I want you to get it very well. So look at this. Now, assuming you are mathematical, a student will say, okay, I know costs minus accumulated depreciation should give me what? The written down value. Do you all agree? Do you all agree?
Yes.
So
Yes.
I know that 2017 is where I incurred the asset, right? 2017, I had the cost of the asset. Then I know depreciation is given as 10% on that same cost, right? For how many years? For 2 years, Meboa. Do you all agree?
Yes.
That happened for 2 years. And that came to give me written down value of what? 500,000. Do you all agree? So a student can put this in mathematics and work out the cost straight, which can be long. So now I know that if I replace cost with X, then I know X minus what? 10% of X times 2, not so, should give me 500,000. So I end up with what? X minus 0.2X should give me 500,000, right? So that means I have what? 0.8X gives me 500 what? 1,000. So if I divide both sides by 0.8, I should get the cost, which is X, to be how much? How much? That means the building was actually
625.
125,000. Is this thing difficult? But it could be quite mechanical for some people, right? And you can do the same thing for the brand name. The brand name has 15 years, but it was acquired when? 2017. So you can also work it out, right? That when you come to the brand name, right, we know cost minus accumulated depreciation or capital allowance should give us the written down value we have now, which was the 600,000, right? So the cost is what we are trying to find, but we know that the cost divided by 15 years also times 2 years have already gone should give us the written down value that we have. Do you understand? So in that case, we know that cost, which we can replace with C, minus C out of 15 times 2 should give us a written down value. So I can divide both sides by 15. We have 15C minus C by 30 equals 30 by the written down value, which is 600,000. And this is quite long. Why would you go through this hectic calculation just to get away? So we have 15C minus 30C equals 30 by 600. And that's how much? That's one. No, it's 18 million. No. Is it not cumbersome?
Mm-hmm.
So 15C minus 2. No, this is 2C, right? It's supposed to be 2C. 2C. Because I multiply both sides by 15, so it's 15. 15, yeah. Okay. So it's supposed to be 2C. So 15C over 15. So that 15 cancels 15. So it's 2C. 15C, 2C. Yeah. So 15C minus 2C, that gives us what? 13C, right? Equals 18 million. So you divide by 13. Divide by 13. Made some mistake somewhere. Did you notice? Let's work through it again. This is what we have, right? So it becomes this over 15. So multiply both sides by 15. Minus 15 times C all over 15. So equals 15 by the written down value, right? So 15 cancels 15. You have 15C minus 2C now equals 15 by 600,000 also. So you have 15C minus 2C, that's 13C. Then 15 by 600,000, that's 9
million.
9 million, yes. So now when we divide both sides by 13, we should get
You get
600.
692 307
this
or 308.
308, right? Okay. So that means that now, if I want to get capital allowance, I'm going to do what? 692,308 all over 15 years, right? No, be so. And
Yes.
capital allowance of what? 46,154, not so, per annum. No, be so. Okay. Now,
Yes.
go up. This one, the cost was 625, and for pool 4 is 10%, right? So 10% on this 625,000, which will give us what? 62,500. No, be so. Okay. Not bad. But why would you go through all this cumbersome process just to get capital allowance? So in simple terms, I told you capital allowance can just be given as what? Take the written down value you know and divide by the remaining life. Do you remember? And you should still get the same thing. So when we take the building, it becomes the capital allowance for the building. What's the written down value? It was 500,000 also. But what's the remaining life? We know the building will have 10 years. And we have used 2 years from it. So we have what? Is it not 8 years remaining?
Yes.
8 years remaining. So just divide this by 8 years. You get a capital allowance for the building straight. Let's try and see.
62,500.
And is it not the same thing we got? So is this not short and simple than what we did, that long mathematical? Is this not straightforward?
Very, very.
It is.
Of course. So why would you worry yourself and go and do all these long mathematical calculations when you can just take the cost, the written down value and just divide by the remaining life? What about the trademark? The brand name. The brand name, we can do the same thing, right? Written down value over the remaining life. Okay, let's see for the trademark and let's see if we get the same thing. Trademark, what the written down value was 600,000 also. And what's the remaining life? We have used, it was 15 years. We have used 2 years from it. So how much do we have left? 13 years, right? So we just divided 600,000 by 13 years. And what do we get?
46,154.
46,154, right? As a capital allowance. And is it the same thing we got? And is it the same thing that we got? Is it the same thing that we got?
Yes.
So now I hope we know a shortcut. Instead of going through that long process, we can just divide them by the reducing balance, the remaining life, if they started business some previous years ago. Are we okay? So that was about how to deal with pool 1 to pool 5 assets. I hope that wasn't bad. Now we are going to disposals. Disposal of assets under capital allowances. So when it comes to disposals, please listen to the rules carefully. The first issue is that once you dispose of assets, right, you just have to take the written down value of the pool, right? The written down value of the pool and just take the consideration, right? That's the disposal amount from it, okay? That's what we learned. So that's all, right? That's what we learned. True or false? There's a second scenario.
True.
Where the written down value of the pool, okay, that means you are disposing of the whole pool. So we are saying that, okay, you want to sell off the whole pool, like you are disposing of all the assets in pool 1, right? So let's say all the assets in pool 1 were 100,000, and you are selling all of them off for, let's say, 90,000, okay? So let's say the consideration received or the disposal is 90,000. So have you made a loss or you have made a gain? Something worth 100, you are selling all off for 90. Have you made a loss or you have made a gain?
You have made a loss.
You have made a loss, right? So this loss of how much? This loss of that 10,000, okay? The law says that grant an additional capital allowance, which we call a balancing allowance, right? To reduce this to 0, because why would you dispose of something and still have its capital allowance in your books? So this whole 10,000, I guess it's an additional capital allowance, which is going to reduce this pool to 0. I hope that makes sense. Because it's like you are disposing of the whole asset from your books. So if you sold and you made a loss on it, reduce the whole thing to 0. So this becomes the capital allowance on this pool. Does that make sense? And that's
Yes, sir.
Are you sure everybody is okay? Are you sure everybody is okay? Or
Yes,
you
sir.
go over again? Do you need me to go over again or everybody's okay?
We are fine, sir.
Okay. Let's go to the third scenario where we make a gain. Okay, so here the written down value of the pool was the same 100,000, right? But we sold off the whole thing, disposal, right? We sold off the whole pool for 120,000. What happened? You see that there's a gain of 20,000, right? So this 20,000 must be added to income, right? You add it to your income. So we call it the additional income for disposal of the pool, right? So this one is an additional income. So when you go, you add it to your assessable income, right? I hope that is not difficult. So anytime you dispose of the whole pool, and then the consideration is more than the pool, are you getting it? You add the excess consideration back to your income. Make sense? Are we getting
Yes.
for realization? So this is realization for depreciable assets, okay? The fourth scenario is where the pool, okay, where the pool is less than 500 cedis. Okay, less than 500 cedis. So let's say here the written down value was 500 cedis and lower. So anytime you have pool less than 500 cedis and lower, you have to grant an additional capital allowance to reduce that 500 to 0, because you can't depreciate something 500 cedis or less, right? So written down value will be no more. So it means that even if you calculate a capital allowance, okay, let's say that maybe the written down value was 400, let's say it was 40 something thousand, right? And then you got capital allowance worth that same, let's say 39,500. No, so it means that you would have had written down value 39,550, right? You would have written down value of 450, right? So this 450, you will still grant an additional capital allowance to reduce the 450 to what? To what? To 0. Meaning your total capital allowance for the year will be that what? The 39,550 that you charged plus the 450 additional one you grant, right? Making the same 40,000. So it means like you have eradicated the whole pool and this becomes your total capital allowance. Is that okay? These are the rules of capital allowance becoming clearer. So are we okay with disposals? Are we okay with disposals? Are we okay with disposals? That's why I'm here for you. If you have any question, you can ask.
Said the fourth one. I don't know whether it's me, but I lost you. The fourth scenario.
When the pool is less 500 cedis or less, reduce it to 0. That's what I mean. So if the pool was less
Okay.
than 500, reduces by 500 to 0. Anything less than 500. So let's say you depreciated it. You ended up with written down value of 450. Take out the whole 450 and add it to your total capital. It's an additional capital allowance. Reduce it to 0. Are you okay now? So let's look at disposal of road.
Okay.
Let's look at the
Yes, sir.
road vehicle. So let's say if you are disposing of a road vehicle, right? So if you are disposing of a road vehicle, especially a non-commercial vehicle, right? So you see non-commercial vehicles, they are limited. So let's say we bought a Toyota Camry, per the question we had, right? We bought a Toyota Camry for, let's say, 180,000 cedis. No, so this is where we bought the Toyota Camry. And then the written down value of the pool. So we are going to do 2 years. So we bought this in 2017. And written down value of the pool in 2017 brought forward, right, was, let's say, 420,000, right? So this is what we have. It means that if you are adding additions, so this is class 2, right? Class 2, 30%. So additions will be what? So additions will limit it to what? How much? 75,000 also. We can capture this one.
75.
So
Yes.
once we do this, what's the depreciation basis? 495, right? So let's get our capital allowance, 365 over 365 for that same year. What do we get? So 495,000.
148.
80%.
500.
500, right? 148,500. 148,500. So that means our what? Our written down value carried forward is going to be what? 495,000 minus our 148,500. And that's 346,500, right? Okay. Now the Toyota Camry, okay, the Toyota Camry was disposed of, okay, for 125,000 in 2018, okay? How do we deal with this? It's a disposal, right? But we cannot charge all the 125,000 to our account. Do you know why? Because we limited this to 75. So it will not be fair to charge the whole 125. It must also be limited. When the value was limited, its consideration must also be limited. Do you all agree with me? Do you all agree with me?
Yes.
So to get a disposal proceed,
Yes.
I'm going to use ratio analysis to say that if 180,000 was limited to how much? 75,000. Do you agree? Then 125,000 will be limited to what amount? Does it make sense? It will be less, right? So if less, more divides. Do you agree? So in that case, that means that the disposal proceed for this asset is going to be what? 125,000 out of the
125,000 over 180,000.
times the 75,000 also. And that means this gives us one. So 125,000 over 180,000 times the 75,000. That means that we would have limited this to 52,083, right? That becomes the value that the disposal has to be limited to. I hope that makes sense. In that case, in the 2018 year of assessment, are you getting it? Written down value brought forward will still be the same written down value that we had, which was what? 346,500, right? 346,500. Were there any additions? No, there were no additions, right? But were there any disposals? Yes, there was a disposal. For how much? So the disposal will be the same amount here, which is what? 52,083, right? So you take it out and that gives you what? Your depreciation what? Basis, okay? So this is everything you need to know about realization, including the disposal of road vehicles, right? I'm teaching you every single thing you need to know about capital allowances in our Ghanaian tax laws. So now we are going to deal with finance leases. How to deal with finance leases, you need to pay close attention. Installment sales, or what we call high purchases, right? High purchase and assets acquired in parts. Assets acquired in parts. I hope you are soaking capital allowance. I hope I simplified it for you. So when it comes to, let's first start with assets acquired in parts. So let's say you are building a complex, right? Now the whole thing is each part that you complete becomes an addition. What did I say? What did I say? I said each part that you what?
That's it. It becomes an addition.
Yeah, it becomes an addition. Is that okay? So let's see. John Paul commenced business on 1st January 2017 and he acquired a partly completed building costing 120,000 on 1st of the 5th, 2017. And John Paul decided to construct 3 floors. So how do you account for 3 floors? If you finish each floor, the cost shall be added as an addition. Do you understand? Is it clear?
Okay.
Yes.
Yes.
So he constructed 3 floors on the building in addition to the initial floor acquired. John Paul completed the first floor on 30th, 2017 and the second floor on 1st, 2nd, 2018. And the cost of the first and second floor were 40,000 and 60,000 respectively. How do we compute the capital allowance? Each floor that we finish, we add it as an addition, right? So in that case, what pool was that? It was building, right? No, be so. It was a building.
Yes.
And like you can separate each floor can be separated as a separate pool. Do you remember? I told you anytime you do work on a class 4 assay, you can separate each as an addition, or you can create brackets and add them. It doesn't really matter. So building is 10% on cost. Do you all get it? So how much did we buy the building initially? Written down value brought forward. How much? It was 120,000. Which year? 2017 year of assessment. Do you all agree? But that same year, did we complete any floor? Yes. Do you all agree? That year, there was an addition. Which one? He completed the first floor, or? No, be so. No, be so.
Yes.
Are you reading the question at all? Please read the question. Don't just watch me. Follow. Because in the exam day, I'll not be there with you. So he completed first floor it's still in 2017, right? And then he incurred 40,000. So that 40,000, won't we treat it as an addition? No, be so. So now our depreciation basis is going to be what?
Okay.
160,000 also. And then we can calculate capital allowance. So capital allowance is going to be what? 10% on the 120,000 we bought
10%.
plus 10% on the 40,000 addition. Do you all agree? Do you all agree? What's our total capital allowance?
Yes.
What's its on cost? It's 16,000 also. So we take it out, and that was the rate
16,000. Yes.
carried forward to the next year. 160,000.
144.
That's 144,000. Okay. Now we go to. Oh, where am I carrying it? Which year? What's the next year? 2018, right? Did something happen in 2018? 2018 year of assessment, what happened? Written down value brought forward is how much? 144. Were there any additions? Did he complete any part of the asset? Did he complete any part of the asset in 2018? I need an answer. Did he complete any part of the asset in 2018?
Yes.
Yes. The first and second floor.
And how much did he incur?
40,000 for the first floor and second, and 60,000 for the second floor.
So there was an addition of how much for the second floor? How much will we add?
60,000.
So what's our depreciation basis? $204,000, right? So in that case, our capital allowance will be what? 10% of the original 120,000 we acquired, right? Plus 10% of the what? The 40,000 last year, plus 10% of what? The 60,000 this year. Do you all agree? Do you all agree? However, you could have created separate pools for each of them. Clear? Yeah, so we end up with 22,000, right? Which becomes the total capital allowance. So this is how we deal with assets that are dealt with in parts. Are we okay? Any questions so far? So let's deal with the final part of capital allowance, finance leases, okay? Let's deal with finance lease. Now, when it comes to finance lease, we have two ways we treat it. For capital allowance, we deal with it in the books of the lessee, okay? So dealing with finance lease, we deal with it in the books of the lessee, and it's just like what we do in accounting, substance over form. The Commissioner General or the tax law looks at what the substance over the legal form. So who has the risk and rewards of ownership, right? That's the person who enjoys capital allowance. So under our law, it's the lessee who enjoys capital allowance, right? The lessor does not enjoy capital allowance. So the lessee enjoys capital allowances, right? On the capital portion. I'll come and explain what that means, right? So he enjoys capital allowance on the capital portion. And then the interest on the what? The lease asset, the finance lease asset is treated as an allowable deduction. These are the two rules you have to understand, okay? So the capital portion, okay, when we say capital portion, it means that when you are paying, you pay both principal and interest, okay? The law says a finance lease is treated like a blended loan. A blended loan is a loan where if you are paying, each payment that you pay is made up of both interest and principal at the same time, okay? And we can make reference to this from section 30 of the Income Tax Act. So since it's a blended loan, it means that each installment that I pay, it is made up of both principal and what? Interest at the same time. And they are saying the principal or the capital portion, you get capital allowance on it. It means that the interest portion is revenue expenditure and it cannot enjoy capital allowance. But however, you can treat it in your P&L. Does it make sense? Have you learned something? Can we take an example? Can we take an example?
Yes, sir.
But have you written this down? Please do. So whether hire purchase or finance lease, we treat them the same. Now, each installment, the installment without the interest, okay? Installment without the interest shall be treated as an addition, right, to the pool. And if it's non-commercial vehicle, the installments shall not exceed 75,000. So that is it. So if only you lease a vehicle, right? We are saying that the total amount you are paying should not exceed 75. It means that it shall also be limited to 75, right? So that at the end of the day, the installments that you are going to charge for capital allowance, when we add all together, it won't exceed the 75,000 limit for the non-commercial vehicle. Do you understand? But however, nobody will worry himself and bring this to exam for you. But in real life or practically, yes, if you are dealing in vehicle businesses, your leases do not exceed 75. Are you putting it down? So this is the worst case scenario for that they can give you. Have you put it down?
Yes, sir.
Can we take a question? So the interest is treated as
Yes, sir.
deduction. Remember, the interest is treated as allowable. Okay, so let's take a question. ABC Limited acquired a manufacturing plant, a manufacturing plant on a finance lease, right? On a finance lease with interest apportioned on a straight line basis, right? With interest apportioned on a straight line basis. The cash price of the asset, was 600,000 cedis, and the total installment to be paid was 120,000 for 7 years, right? 120,000 for 7 years. So this is what we have. No, let me just make it, let me change this. 120,000 for 7 years. I don't want it to be 7 years. Let's make it, okay, 150,000 for 5 years, right? For 5 years. Okay. So this is what we have, 150,000 for 5 years. Are we okay? This is what we have. Then they are telling us that what show or explain the tax implication, right? The tax implication. So this is, we are in the 2019 year of assessment, right? 2019 year of assessment. And we have the written down value for pool 2, right? So written down value for pool 2 being 1.2 million, okay? So we have 1.2 million. This is what we have for the pool. And I said, let's compute capital allowance for 2019 and 2020. Okay, so this is what we have. 2019 and 2020. So in that case, please put this question down quickly and let's learn how to. Okay. And let's quick. If you are done, you tell me. I don't know what is wrong with this network because of the rains or what. Oh, you know what is wrong. I'm not able to. Computer is frozen. Can you hear me?
Yes.
I cannot show my screen.
Yes, you can.
I'm not able to share my screen.
Yes.
I'm not able to click anything. I don't know what happened. Okay. Computer is frozen. Teams is prompting me that time is happening.
Yes, sir.
But the whole thing is, look, how much installment are you paying? How much installment was the guy paying? Hmm? The
What's-
cash price of the asset is 600,000, okay? And they said he's paying 150,000 for 5 years. So every year you pay 150,000,
Yeah.
150 by 5 years, what do you get?
750,000.
750, right? Okay. Something that is worth
Yes.
something that is worth 600, you are paying 750 for it. So how much extra did you pay?
One.
It means that you paid additional consideration of 150. Is that not so? So since you paid additional consideration of 150, it means that that additional consideration stands for the interest. Do you all agree?
Mm.
Do you all agree?
Yes.
Do you all agree? That's what I was trying to say. Hello?
Yes, sir.
Is my voice, am I audible? Am I audible? Can you see my screen?
Yes.
So let's determine the interest. So let's see, determination of total interest, okay? So what's the cash price of the asset? So if we are to buy,
600.
we can buy this same asset for what? 600,000 or so, okay? And then what's the total installments? I don't know why they keep saying
750.
okay, total installments. We are paying 600,000 by 5 years. Okay. 150 by 5 years, right? And that's 750,000. Okay, so that means that the total interest
Yes, sir.
was 150,000 also. 150,000. Okay, so in that case, what's the interest expense per annum? What's the interest expense per annum? We know that the total interest was 150,000. It's apportioned over 5 years, right? So what's the interest every year? That's an just more rain, that rain. The MTN's network is completely messed up. I don't know. The telecom network me. So how much do we get? That means it's 30,000
30,000.
per annum, right? So the law is saying that this 30,000 per
Yes.
annum treat it as an allowable deduction because it's wholly, exclusively, and necessarily incurred for the purpose of this lease asset that was used in your business, right? Because this one was for the manufacturing plant, so capture it under pool 2. Do you get it? But we have to strip off the interest portion from the principal first. Do you understand? So it means that if we take our total installments, which was how much? How much is each installment every year?
Easy.
Every year, how much installment do we pay? Is it not 150?
Yes.
Now, out of that 150, we are saying that the interest portion, because I said with a blended loan, each installment is always made up of principal and what? Interest. Is that not so? So the law is saying that each time you make an installment, the interest portion shall not be allowed for capital allowance purposes, right? It shall be taken as an allowable deduction. So this 30,000 is in this 150, right? Because this is both principal and interest, okay? Which is the amount you are paying. So when I strip off the 30,000 from this 150, how much is left? That becomes the capital portion, which we can grant capital allowance.
120.
That means every year we shall add this as an addition to the pool, right? For capital allowance purposes. Do you understand? But the interest portion shall be allowed as an allowable deduction. Do you get it? Do you get it?
Okay. Yes, sir.
The total 150 that we pay is a blended. And I told you, I asked, what is a blended loan? I taught you what a blended loan is. What is a blended loan? What is a blended loan? Oh, I taught you this today. What is a blended loan?
Loan consisting of principal and interest.
A loan that anytime you are paying, the installment you pay is made up of interest and principal payment at the same time, right? So that kind of loan, anytime you're dealing with a finance lease or high purchase is considered like what? A blended loan. So it means that take the interest portion for the installment and that capital portion, you add it for capital allowance purposes. It means that if for the 2017, you want to compute capital allowance for the pool 2 asset, right? Which was 30%. When we bring the written down value brought forward, which we said was what? 1.2 million also, we'll do additions, right? We'll add a finance lease to our additions, right? And the addition, we said every year we'll charge 120,000. Do you remember? So this becomes what? Our depreciation what?
Yes.
Do you get it? So you see the finance lease. So this one is without what? Interest, right? Interest cannot come to our capital portion. Remember, the interest is an allowable deduction, which we did. So this one, what? This becomes what? 1,320,000, right? Then we now grant capital allowance at the specified rate, right? And that gives us what? So since it's over 5 years, capital allowance will be what? $396,000, right? No be so. So in that case, written down value carried forward will be what? $924,000 also. When I get to 2018 year of assessment, also the same way, in 2019, I will just what 2018 year of assessment, I'll still bring my written down value brought forward, which is the 924,000. Then I'll bring my next installment, right? And my next installment to be treated as an addition. Okay, which will be what? 120,000, right? And that year to 30,000
120,000.
be treated as an allowable deduction again. So the interest will be treated as 30,000 allowable deduction, 30,000 allowable deduction, till the time I will exhaust this finance lease asset from my books, right? So this will be treated as an addition. We'll add it to the 924, like that, till the 5 years exhaust, right? So that's how you deal with high purchase and finance lease. I hope it wasn't a difficult one at all. I hope it wasn't difficult. Any question?